over the last 5 or 6 years, a lot of money has been invested in the coal industry, and a lot of companies actually have accumulated low-risk resources. I think they're in hand for most of the producers. And so that's almost a given. Most of the good companies now have actually good resources. So where we're moving in terms of the value uptick is traditional metrics like perhaps proved reserve life and net asset value are likely to be de-emphasized in this market. Instead, we think that cash flow-based metrics will be preferred. In that, what I mean by that is converting those resources, those molecules into the ground, into cash flow. A quick geology 101 on coal, but coal is varied, so it's not just one single commodity. It's actually its quality is also dependent on the its price is actually dependent on its quality. So on the right hand side, you have increasing carbon energy content. So across there you see some of the more expensive coals in terms of market valuations. The metallurgical coals, often called coking coals, are used for the manufacture of iron and steel. And there's the bituminous and the sub-bituminous coals have probably got a lower carbon energy content and perhaps higher moisture, and they're least value. The high-grade stuff is usually the hard coal, the bituminous type quality coal, which is high energy and low moisture, and the real low-energy coals, the low-rank coals, are the lignite coals. They're kind of brown, often used for power generation, but also what we call mine mouth generation, which means you don't have to transport the coal too much to get into power stations. So lignite coals are usually the lower value ones in terms of a dollar per tonne, and the bituminous ones are the higher. You can see this. I think current spot price today is about $61, $62 based against the Australian Newcastle FOB benchmark. It is an interesting slide in that over the last, since the peak probably in 2011 on this slide, the coal spot price has gone down about 40%. You can see as an investor or as a banker, when you have to do a valuation on a project, you usually need to base yourself on some kind of price deck or price assumption. It's extremely hard to do that in this market, especially post Lehman, when you have such a falling price of a commodity, but also very volatile. I had to look up to see what the coal price was today. Was it 61 or 65 or 58? I wasn't sure. That shows you how volatile the market is. In the good old days when I was a geologist 15, 20 years ago, the coal price was $30, $32, and it didn't really change for 6 months. But now it is different times, so the price is volatile. Very difficult to pin a valuation sometimes because of that. We've come out of a period of sustained production growth. Almost every single country that produces coal over the last 10 years has actually increased their production manyfold, and I'll show you some examples of that later. And now we're coming into an area of oversupply. And that's why when you get oversupply, why we've sort of had this kind of oversupply, therefore the prices are falling. But there's also some other factors of why. Because you would think last year when the prices started dropping, that most producers would stop some of their production because they're not getting that much money for their tonne of coal. You would think low price, therefore production fall off. In fact, it was actually counter that. The opposite happened. What miners have been trying to do is actually increase their production to counteract the lower price, and so their unit average cost of coal is averaged out. So it's a kind of a bizarre event that most of the big producers, including Australia and Indonesia, have recorded larger production volumes last year when price was falling than, say, the year before. So this is going to obviously have an impact because it just means more supply, which means the price is going to continue to fall. CapEx budgets remain tight. CapEx is actually the money you put into the ground, and mining investment is declining, and these are just some of the trends that we're seeing at the moment. And production across most commodities is well supplied following sustained capital development. So the industry has faced a lot of mine closures, and obviously the most expensive people on the cost curve are the first to go. Back to my quote about the survival of the fittest. The most expensive, the least efficient, are usually the first to close. So here's an example of some of the global metallurgical coal mines that shut in last year, quite a lot. Most of these, though, I have to say, came out of the US, and it's actually For example, it's currently not economical to export seaborne coal at today's coal price from the US to Asia because there's a large amount of transportation involved. So you can see the amount of closures, most of them in the US and some from Australia. Now here's the key, what I feel is happening in the market. Producers, as I said, are increasing their output at the mine level and reducing their cost to lower the average unit cost when responding to falling coal prices. Hence, these lower prices may not lead to lower supply in the short term. This is my favorite slide. What I actually think, if any one of you who have watched Alice in Wonderland will know the Red Queen. And there's an area in, there's a part of the book or the movie where Alice is running around the forest. She keeps on running and running and running. And when she finished running, she's realized she's in the same spot. So she's done all this running and she hasn't got anywhere. And so the Red Queen says, now, here you see, it takes all the running you can do to keep in the same place. If you want to get somewhere else, you must run at least twice as fast as that. And I kind of feel that's what our coal guys are doing, unfortunately. They're kind of trying to play catch up and run twice as fast as in produce much more coal. And that's actually having an adverse impact on the coal price. What are financial investors doing? I think financial investors are, a lot of them, there's a lot of money in the market. There's a lot of private equity funds, a lot of private individuals that are looking to invest in resources and coal. But at the moment, they're kind of waiting on the sidelines for that good opportunity. And some of them believe that this down cycle could last longer than expected. And they're waiting for the valuations to come lower. And there might be a bit more pain than gain. But as you know from some of the investment greats before us, like Warren Buffett and co, they always take an anti-contrarian view and they buy low and sell high. So we're pretty low in the coal market today. So a lot of these investors are actually waiting for further discounts. China is very interesting. It's I mentioned earlier survival of the fittest, but because of the China industry, it's failed to eliminate uncompetitive miners because the governments keep on trying to bail some of those out. So it's very hard to take a view internally on China on what the lowest cost structures are or how free that market is trading. So that's keeping a lot of coal miners alive when perhaps if they were trading in the Western world, they may not have been so fortunate.